Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's episode, we're going to talk about the recent banking crisis that started when Silicon Valley Bank ceased operations on March 10th. It's on everyone's mind. It's caused widespread fear because you hear of a bank failure. You hear that account holders may not have access to their money and that it may spread to other banks. So today we'll talk about what happened, what could happen next, and things you could do to protect yourself. All right, so like I said, on Friday, March 10th, Silicon Valley Bank, which is a unique lender in that it lends to some of the biggest names in the technology world, it became the largest bank to fail since the 2008 financial crisis. And this kind of happened out of the blue. Bank regulators shut down the bank and it suffered a sudden, swift collapse. Just 2 days prior, SVB signaled that it was facing a cash crunch. It first tried to raise money by selling shares. Then the bank tried to sell itself. But all of this movement, it spooked investors. So many companies or individuals with money at SVB, they moved to pull their funds out, which is called a bank run, and it contributed to the bank's demise. The bank wasn't done in by lending to risky startups or some crypto collapse. Like I said, it was an old-fashioned bank run, similar to the one that you see in the movie It's a Wonderful Life. And how it happened, in 2021, the stock market was booming. Interest rates are close to zero. Money flooded into the tech sector. So what happened was a lot of these startups, they parked their cash at SVB, and SVB did what many banks do. They took the cash and they invested it in things like long-term bonds. I think one of the common misnomers is like if someone opens up an account at a bank or that money goes in a vault and it's readily available once they want to call upon it. And that's not true. Banks go and they take that money, and oftentimes they're able to use leverage on that money. So if someone deposits $1,000, they're able to go and take it and use $2,000, whether it's to make loans or invest in something. In this case, SVB invested in long-term bonds and mainly treasuries. So quick explanation on how bonds work and how their prices can be impacted by interest rates which is what we saw happen last year. So if we'll use an example, let's say you have a 10-year bond. That's a bond that you buy today that you pay up your principal in. You're the bondholder. Whoever's issuing that bond, in 10 years, they pay you back. So let's say that bond costs $100 a bond and it pays an interest rate of 2%. If interest rates rise, like what we saw last year, somewhat into this year as well, and the rate for that same 10-year bond that cost you $100 is now 5%, no one would pay $100 for your bond that pays 2%, right? Because if they can get a bond that pays 5%, they definitely want that. So the market value of your bond drops from $100 a bond to, let's say, $90 a bond. Now you'll still receive that 2% interest, and you'll still receive $100 back after 10 years, right? So it's not that big a deal if you don't have to sell your bond. At the end of the 10 years, your bond matures, you get your $100 per bond principal back. But this isn't what happened to Silicon Valley Bank. In 2022, interest rates rose and the value of the bonds in SVB's portfolio had steep losses. Not uncommon to a lot of financial institutions that were buying bonds. So now on paper, they're sitting on a lot of paper losses. This would be like if customers' deposits totaled $100 million, but after the loss of the bonds, the portfolio was only worth $75 million. So like I said, on paper, it's not necessarily the big problem. But recently, investment in the tech startup space dried up. Remember, tech startups are the main niche or clientele of SVB. So tech companies had to start pulling out cash that they had parked at SVB to pay for things like expenses. So to meet those obligations, SVB had to sell some of the bonds that were in their portfolio at a loss to be able to provide the cash back or the withdrawals from the customers. Now, when SVB explained what had happened to customers, it snowballed, and other companies, other people panicked and started pulling their funds out from SVB, and therefore that's how that bank run is created. Now, they didn't have enough money to cover their withdrawals. So that's like you going to the bank, writing out a withdrawal slip, and the bank coming back and saying, sorry, we don't have the money to be able to give to you. During this bank run, not everyone was able to get their cash out of the bank. The FDIC only insures deposits up to $250,000, and we'll cover a little bit more about that in a second. And then that's what can spread that fear and panic to other banks. So this happened on Friday, March 10th. On Sunday, March 12th, the federal government came in. Now, the federal government wants to stop the widespread panic and fear. So it came in and said it would take steps to make sure that all the bank depositors would have access to their funds by Monday, March 13th. At the same time, regulators also shuttered another bank, Signature Bank of New York. Now, Signature Bank, over the past couple of years, it's well known. It's one of the pioneers into the crypto space. Now, crypto had nothing to do with issues with Signature, but the same thing happened to them as what happened to SVB. Now, the Fed came in and said not only will accounts that were FDIC insured have access to their money, but even accounts over the FDIC insurance amount will have access. So they tried to really come in and really assure bank customers or account holders that they would have access to their money. One thing to note, which is different about this financial crisis than the last big one in 2008, 2009, is that in 2008, a lot of the bailouts came to the banks, the executives, and to the shareholders. So shareholders is if you would own stock in SVB or stock in Signature. With this crisis, the government stepping in and making sure that the FDIC and non-FDIC insured account holders will have access to their funds first. They're actually letting these banks fail in terms of their stock price going down or having to shut operations and executives potentially losing their jobs. They're really trying to protect the account holders. So all this going in, and even the Fed coming in and saying that we're going to protect the account holders, it's obviously sending shockwaves across the financial sector, creating a lot of doubt in the U.S. banking industry amid concerns about, is my bank next? So let's talk a little bit about whether you should be worried about your bank. At the end of 2022, SVB, it was the 16th largest bank in the U.S. It had $209 billion in assets. And like I said, it's unlike some of the big typical banks like Chase, Bank of America, Wells Fargo. SVB's clients, they're venture capital companies and tech companies. And since Silicon Valley serves mostly businesses, FDIC limits of $250,000, they don't really mean that much. And it's actually projected that 95% of SVB's deposits were over that FDIC insurance amount and not insured, which comes from filings with the SEC. A lot of this was kind of brought on by the Fed rate hikes over the past year and a half, 2 years, because this is what has hurt a lot of the investment portfolios of the banks. As I mentioned, SVB invested in long-term treasuries, mortgage-backed securities, and since interest rates have substantially increased over that period of time, these bonds were worth a lot less. So they could have done things differently with their investments. They were buying long-term treasuries. Buying short-term treasuries would have been a little bit better because it would have somewhat insulated them from rising rates. It would have lessened the income they would have received. But again, this goes to the risk-return profile. So SVB's clients were pulling out money from their accounts. Deposits fell from $200 billion at the end of March of 2022 to $173 billion at the end of 22, and that they kind of knew that they saw this trend of, and they forecasted that deposits would continue to decline in 2022. So this collapse really highlights the risk that a lot of banks have in their investment portfolios. Most banks have enough capital to absorb the losses, meaning that even with the portfolios being down, and if there is customers that pull out money, they're able to cover that without having to sell things at a loss. Obviously, a question that comes out of this is which other banks misjudged the match between the cost of the lifespan of their deposits and the yield and duration of their assets. Let's talk about FDIC insurance, because I think that's one of the things that as an account holder you can really look at. I think it will be hard now that the government has backstopped both FDIC and non-FDIC insurance amounts for them to go back and say, all right, we're only going to, going forward, we're only going to do FDIC insurance. But you never know what will happen next. And, trying to, as best as possible, to get your accounts under the FDIC limits is definitely a good step to take. Created in 1933, the purpose of the FDIC is to prevent run-on-the-bank scenario. So exactly what happened here. And here's how the insurance works. The FDIC insures deposits, which are cash, money market, CDs, up to $250,000 per depositor, per federally insured institution, per account category. So the account category piece of this is where things can get complex. There are 14 category account ownership types. The most common ones are single accounts, joint accounts, revocable or irrevocable trust, certain retirement accounts, business accounts, employee benefit plan accounts. In the show notes, I'll link to the full list of the 14 different account types. But between those three aspects of FDIC insurance, you're able to insure more than $250,000. So let's look at a couple different examples. So let's say you have $200,000 in a savings account, $100,000 in a CD at one bank. Because the total amount is $300,000 and they're both in the same account category, your total amount is $300,000 that you have at the bank. However, the FDIC is only going to insure $250,000 of that. So in this case, we saw one person, one bank, one category, and over the limit. If they had split the categories up, like maybe adding a joint account to this. So an example of that is, let's say you're married and as a couple you have a $500,000 joint bank account and each $250,000 in your own single accounts. That's one way where you can get $1 million of coverage. So you have $500,000 in your joint bank account and each $250,000 in a single account. So in that case, the full $1 million is covered. So if you have more than $250,000 deposited in an account type with a single bank, you may need to spread out the assets among multiple banks. And that's if you utilize at one bank all your account categories that you can use and you still have more over the FDIC limit, you may need to utilize more banks. And there are no limits to the number of banks that someone can use. So as an example, you could theoretically open up 200 accounts at 200 different banks just in that one single account category and get $50 million of coverage. Now, of course, managing relationships with 200 different banks, it would be a nightmare, but one of the important things is just understanding how the insurance works across those three things: account owner, ownership category, and then bank. If you are a business with a high cash balance, there's a program called CDARS, C-D-A-R-S, which is an acronym for Certificate of Deposit Account Registry Service. And you may find that useful to use to obtain additional FDIC insurance. And here the concept is simple. Instead of manually opening up savings accounts in different banks on your own, you can make one large deposit with your CDARS member bank. And after you open up this one account, you disclose what financial institutions you already have deposits at. The CDARS network will divide your large sum into smaller amounts, calculated not to exceed the $250,000 over the lifespan of the CD. Those smaller sums become CD accounts at member institutions across the country. So you can look at it as, instead of you having to open up all these different accounts, you have your main bank that's part of the CDARS network, and you can deposit $10 million there. And what they'll do is they will go to other members of the CDARS network and actually allocate that $10 million into $250,000 chunks. One thing worth noting about FDIC insurance, it doesn't cover things like mutual funds, annuities, life insurance policies, stocks, bonds, and we'll talk a little bit about this when we talk about SIPC insurance next. All right, so now how FDIC insurance works is what happens when the bank fails. So what happens when the bank fails, the FDIC comes in, it becomes the receiver of all deposits, and then it usually arranges for another healthy bank to take over management. Alternatively, which it looks like this is what is happening in this case, the FDIC may cover the deposits directly and kind of facilitate that access for account owners to get access to their funds held at the now defunct bank. And then just as we're talking about a bank failure, there's the account holders. And really by law, what happens is once the insured depositors are paid, uninsured depositors are next, which in this case, it looks like they're in the same line that the insured depositors are. Then come the company's general creditors, the stockholders, and you see the stockholders are usually down the line, and usually they're last to get any recovery from a bank going, or in any case, a company going under. I mentioned that 95% of the Silicon Valley bank deposits were uninsured. Similarly, at Signature Bank, 90% it looks like were uninsured. And just one thing to note, I remember a lot from the bailouts in 2008, 2009, a lot of people were thinking about or worried about taxpayers were going to be on the hook for bailing out these companies that failed. The FDIC has come out and said that they will avoid relying on taxpayer funds to cover the losses, and the way they're going to do that is they're going to levy an additional fee on banks. Now, you kind of can see where that's going to lead. The banks are just going to kind of pass that on to the consumer, but at least they're not going directly after taxpayers to recover this. All right, so I mentioned how FDIC insurance works. Here's how SIPC Insurance works. It's a little bit different. SIPC is an acronym for SIPC, an acronym for the Securities Investor Protection Corporation. And this was a nonprofit corporation created in 1970 by Congress. What this is to protect clients of brokerage firms that are forced into bankruptcy. So there is a difference in terms of how banks and brokerage firms are structured. And brokerage firms, you could think of where your investment account is, or maybe you have an IRA or a 401k there. One of the common misconceptions is that SIPC covers the value of a security you have in your account, and this is obviously not true. If you have, let's say, Apple stock, and Apple stock loses value, you're not protected by SIPC. The focus of it's getting assets returned from a bankrupt or financially troubled brokerage or investment firm. So on the cash side, it provides up to $500,000 coverage of cash. On the security side, it provides additional coverage. In light of these events, there are a couple things to double check, even though, like I said, it's probably hard for the government to come in and reverse the unlimited deposit guarantee. So one, you want to make sure you're working with an FDIC insured bank. Surprisingly, not all institutions have to be covered. So again, I'll put a link in the show notes where someone can look up, it's a tool where someone can look up and just confirm that their bank is FDIC insured. If you have deposits over the FDIC limit at a bank, probably makes sense to try and see how you can spread those either across, create new account categories, a new account ownership, or spread it across multiple financial institutions. The other thing you want to do too is, especially if you're using a small, mid-sized regional bank, you want to check the bank's solvency ratio. This is known as the risk-based capital ratio, and it's calculated, it takes the regulatory capital divided by the risk-weighted assets that they have on their portfolio. While this ratio is not necessarily strictly for financial institutions, it can be applied to companies like banks to assess how well they can cover both short and long-term financial obligations. Any solvency ratio below 20%, it's something that you want to look at because it could increase the likelihood of default. So you basically want to check what's the health of a bank and how well capitalized are they to meet demands, and in this case, if another bank run happens. So finally, what's next for the markets? We're definitely seeing some volatility in the stock market. It's probably going to continue because, if you look at how options are being traded and how the market is moving, it's projecting that there may be more bank failures that come. On Monday, the financial services sector was down sharply. A company like First Republic, who was thought to be next on the list to shut down, saw their stock drop 60%. On Tuesday, the sector rebounded and gained a lot of what was lost on Monday. On Wednesday, we're seeing another drop as it's back to worrying more about bank failures. In this case, specifically Credit Suisse has been in the headlines. Prior to this week, interest rates have been what was driving the markets primarily. It was expected that we'd see another 25 basis point, which is a 0.25% hike next week. Now the prediction is that there'll be a 75 basis point cut. And the reason is raising the rates puts more pressure on these financial institutions, and you don't want to push them over the edge. So this, SVB's demise and put a lot of pressure on the Fed to rethink its economic tightening, and the markets are pricing in a pivot to rate cuts this year. So that's another thing that we're looking out and seeing. We have this banking crisis, but also potentially a turnaround from raising rates to lowering rates. The market likes when rates are lowered. So we're keeping an eye on that as well. So thanks to everyone who tuned in to today's episode. Don't forget to follow the Agent of Wealth on the platform you listen to. If you have any questions about specifically how this is impacting you, potentially impacting you, we're happy to talk. You can schedule a one-on-one call with us from our website, bautisfinancial.com/call. We'll talk to you soon.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.